In this tutorial, we're going to take a look at adjustments. And this is the first content. I'm going to make two tutorials here. The first will handle the first two, and the second, number 3 and 4. Adjustments are basically exactly what, as it says here, the name suggests. They're adjustments made to the books of a company at the end of an accounting cycle to fix something. That's what they're for. And if you scroll down to you should read the content all, but I'm going to take a look at most of the examples here. The first one they talk about is a late invoice. So for example, this company on January 10th, they got an invoice for work that was done the previous year. Okay, done here it says on December 29th. And so this is a late invoice. It's not in time for the books and the statements for last year's accounting statements, but it's received in January this year. So the journal entry would look like this. It was for repairs and maintenance, totaled $750. And so we got the invoice and to pay it on January 10th. And so we would debit repairs and maintenance expense, $750. And accounts payable would be credited $750 unless you would decide to pay a cash, and then that would just be cash or bank would be credited $750. And the repairs, and then the note here in the particulars is repairs to boiler late last year. Just giving some details of what that was all about. Now that's really the same kind of entry as though it were done in last year. If the work had been done December 29th and you received the invoice on December 30th, for example, then that could have actually been included in last year's statements. So that's the only example from the first content. If we go to the next one, accruals. Accruals refer to things that build up or accumulate over time. For example, and one of the examples they give here is paying rent at the beginning of the year for the entire year. That's often done with insurance as well. So the examples here, this prepaid expense, this company pays $1,000 a month rent for an entire year, so that's $12,000 for the year. So for the on January 1st, they would debit $12,000, $1,000 a month for 12 months, in an account called prepaid rent. And then cash would be credited $12,000. Now this has to be cash. This could not be accounts payable because something isn't prepaid if you haven't paid for it. So this would have to be cash. So this $12,000 prepaid rent account is really just a tally of how much rent the company has paid in advance. Okay, and then each month as you go through, they're paying $1,000. This $12,000 is $1,000 a month for 12 months. So each month, January 31st, end of February, March, April, etc., they would credit $1,000 from debit rent expense. So rent expense is an account where you keep track of that expense. That's going to be used on the income statement, for example, to figure what your net income is for the year. And so $1,000 is debited to rent expense, and $1,000 comes off prepaid rent. Notice this was a $12,000 debit. You really think of that like an asset. Prepaid rent is an asset. It's rent that we've paid in advance. Okay, so it really is an asset. That's why it has a debit balance. And at the end of each month, this prepaid rent has $1,000 taken off it, so credited. And so when we do that 12 times at the end of the fiscal year, the prepaid rent then would be down to zero because at the end of the period, there's no prepaid rent anymore. So every month, every month is $1,000 is transferred from this account to the rent expense account. So at the end of a year, you'd have accounted for $12,000 in rent expense. But you can't actually call it an expense until you've actually used it. So time simply has to pass through the 12 months in order to get $12,000 in rent expense. So that's an example of a prepaid expense. Now the unearned revenue is the next one here. And the unearned revenue example here refers to, actually these two are are very much linked to these two. These two entries are from the point of view of the seller of the rental property. This is the company that's renting. This is the company and how they would account for or record the rental income, the rental revenue. So at the beginning of January 1st, the company that's renting paid for $12,000 rent in advance. So the company that's renting the rental property, they would receive $12,000, but they haven't actually earned that revenue yet. Time has to pass before they can actually say that they earned $12,000 rental income. For example, if the company decides after a month that they're going to move, and as long as they have this lease agreement, then they wouldn't have $12,000 in rent that's earned, revenue that's earned. They would have perhaps a month, and then that's it. So the company that's renting the property, they get $12,000 in cash, and so they would credit an account for what's called unearned revenue. So this is an account that keeps track of how much revenue this company should get over the period of a year for that rental property. And every month, then what they would do is they would take $1,000 out of that unearned revenue, and so here it is right here, it's coming out of the unearned revenue. This has a credit balance, okay? And so we would debit $1,000 out of it each month, and then $1,000 goes into the credit account for rental revenue. Remember, revenue has a credit balance because it serves to increase capital on the liability side. So that's what happens at the end of every month. So at the end of the year, there'd be no unearned revenue here. This would actually be down to zero, and then that renting company would have $12,000 altogether in rental revenue. So it'd be as though the $12,000 here has gone here at the end of the 12 months. Okay, down to the borrowing and interest example. Interest is really the cost of borrowing money. That's what interest is. And they give a couple of examples here. The first entry when you take out a loan for a business is you have to record the whole loan. And so the example here was that this company took a $100,000 bank loan out on July 15th. So if you're getting a loan for $100,000 from the bank, then the bank's really giving you $100,000 in cash. So your cash or bank goes up $100,000, that's the debit, and you record it as a loan payable of $100,000. And so there's the particular took out a $100,000 6% loan. Now, the interest is 6% per year. So in order to calculate the amount of interest for a month, what you would do is you take the $100,000 and multiply it by 0.06. Now that would give you the amount of interest for a whole year. If you want it for a month, then we would divide that by 12. So for 1 month, they're paying $500 interest for a month. Now a lot of times you take out bank loans, they're not right dead on with when you want to update your books, like at the end of a month. So in the example here, the loan was taken out on July 15th, middle of the month, and they're going to they don't actually have to pay the bank their first installment of interest till August 15th, a month away, but they're supposed to record in their books at the end of the month, what's happening. So on July 31st, their interest expense would be half of a month because it's 2 weeks from July 15th to the 30th. And so if you divide 500 by 2 for half of a month, that's $250. So they would have accumulated $250 in interest expense. So that's an expense, again, that will serve to reduce your net income when you in your income statement. And then you would credit $250 interest payable. So that's keeping track of how much money in interest the company is going to have to pay the bank a little later on, actually the middle of the next month. So we move down the line here a little bit. And so on August 15th, another half a month later, the company has to pay the bank this $500 in interest. Well, it's really 2 weeks more. So in 2 weeks more, they would have another $250 in interest expense. So notice that this $250 and this $250 add to $500. What this interest payable debit of $250 does is removes that. So we credited because on the 31st of July, the company said, well, at this point we owe the bank $250 in interest. So we'll remove that. So this entry and this entry means at that point there's no more interest payable to the bank because we're actually going to pay them today. And so 250 from the first 2 weeks and 250 from the next 2 weeks adds up to $500. And so they would pay the bank $500 for that interest for the whole month. Okay, salaries and wages. Now, salaries and wages are very similar to the interest. A lot of you have a certain amount of salaries. For example, in this example here, salaries expense for 2 weeks was $10,000. So the journal entry, and if you notice in the example, so every 2 weeks they're going to pay their employees $10,000. So that was the last payday. So this is only 1 week down the road. So we're not actually going to pay our employees on the 31st. The next payday is actually August 7th. And so, but end of the month, you still have to record what you owe, for example. And so if it's $10,000 every 2 weeks, then in 1 week there's really $5,000 of salaries that we owe to our employees. And so you record that like this. July 31st, there's salary expense of $5,000. We're not actually paying the employees today. We're just keeping track of what we will owe them. And so salaries payable, which is a record of, just recording that we know we owe the employees $5,000, so on payday we can pay them the right amount. So this is keeping track of, for the income statement again, how much we're paying out in salaries for the year or whatever time frame, and the salaries payable gets credited $5,000. Again, that's keeping track of how much you have to pay your employees. So another week goes by, and so on August 7th they're actually going to pay the employees this $10,000. So we have another $5,000 of salaries expense. So this $5,000 and this $5,000 add to 10. So that's why cash is credited $10,000. This $5,000 salary payable debit removes this one because we're actually going to pay the employees on August 7th. So we have no more payable to them once we actually pay them. And that's the end of the first content tutorial.